For the past 10 years, we are in the longest running bull market, and just this week, the S&P 500 broke all-time high. We have heard about this wisdom from the media. In order to earn from the stock, you have to buy low and sell high. All the experts are saying that a recession is coming soon. They've been saying that for the past 10 years. Jay Bowman made a chart comparing what the experts said versus what is happening in the market. In 2012, Paul B. Ferret said that the real crash is dead ahead. Later that year, Mark Faber warned, prepare for the massive market meltdown. In 2015, Paul B. Ferret said that the crash of 2016 is coming. It is dead ahead. Mark Faber said in 2017, something will happen. I don't know what it is, but something will happen. Well, Mark Faber, whatever it is definitely not a crash. So now, with an all-time high, and with the experts telling that a recession is coming soon, surely it's a good time to sell your stocks now? I don't know lah. Sorry about that Singlish accent. It comes up from time to time. The truth is, nobody knows when the recession is coming. Not even Abraham Lincoln. I don't know when the recession is coming. Just in case you didn't get it, it was just a joke. Of course, if you are shouting that a recession is coming soon every year, you will be getting it correct eventually. It would be the same as me in an exam circling the answers A, B, C and D and handing in. I'll be getting full marks for that. Don't do that, it doesn't work. Consistently timing the market is next to impossible. If it was so easy, all the day traders will be busy counting their money instead of teaching people how to day trade. In fact, it was so bad that eToro, a trading website, has to put a disclaimer all the way down their website to tell people that 75% of the traders lose money. And this is especially true for new traders like me 2 years ago, who thinks that he's the chosen one and can predict the stock market. But instead, he loses money. Which brings me back to the main point. When should you sell the stock if you can't predict the stock market? Well, dear random viewer, you just do not go and try to time the market. You go with the flow. Be the market. Namaste. That aside, I'll be sharing with you a few simple rules when you should sell your stock or your index funds. But before that, tap the like button to help out with the channel. First off, when should you sell your index fund? If you are holding a broad market index fund like BT-SAX, there are just two basic scenarios which you have to care. Your index fund went up, just buy more because historically the market has and will continue to go up. Your index fund went down, just buy more too because you can now buy your index funds at a lower price. It's just that simple. Well, you may ask, what if a World War III happened? Do I have to sell my stock? Let me assure you, trying to sell your stock when the World War III hits is the least of your worries. Well, that aside, just look at the past 100 years. The market has went through World War I, World War II, the Vietnam War, the Cold War, and now the trade war. Never ever sell your index funds because the market has proven that no matter what, it has and will continue to go up no matter what. An index fund is self-cleansing. What it means is that in the event that a company closes down, it will just replace that closed down company with another company. Now then, with the index fund aside, let's talk about stocks. There are a few simple rules which I just follow. Rule number 1. You sell your stock when it is no longer profitable. You see, no matter how the market price fluctuates in the short term, the company's stock's market price will always follow its profitability in the long term. Take this chart for example. The price may deviate up or down, but in the long run, the price will always move together with the profitability. So how do you know that profitability of the company has gone down? So let's use McDonald's for our example. In 1992, someone bought a cup of hot coffee and she accidentally spilled it on herself and burnt herself. And she filed a lawsuit against McDonald's for failing to warn her that a cup of coffee is too hot. Sure, McDonald's suffered some losses by having to pay her some money, but that doesn't affect the profitability of the company in the long term. What will affect McDonald's long-term profitability is that when a better and a cooler burger-making company appeared out of nowhere, introducing McDonald's. And when you see your friends and family preferring to eat at McDonald's rather than McDonald's, you can be sure that the long-term profitability of McDonald's will go down. Another factor is shifting consumer trends. If you see more and more people preferring to eat healthier food rather than McDonald's and McDonald's, and if they haven't started innovating and create better and healthier food, you can be sure that the company will start losing money. And when you see that happens, perhaps you want to sell your McDonald's stock and move to a healthier choice company like Subway. Rule number 2, you sell a stock when it has become too expensive. Let me give you the best example right now. There's no other stock than Tesla, the current hype machine. Its stock price has been going up for the past 6 months. In the short term, the market is irrational, and its price will swing wildly like a rodeo bull. Eventually, when the hype dies down and people start selling their stock, the price will crash and it will go back to its original value. That reminded me of a story in the 17th century. You see, back then, tulips were new to the Netherlands and they were hard to get. This made the tulips into the luxury item. And if you see anyone having tulips, that means he is rich and powerful. So people started collecting tulips like Pokemon cards. As the popularity of the tulips grew, so did its price. In fact, the tulip became more expensive than a house. This went on until the spring of 1637 when people started realizing that the price of the tulips were insane and they stopped buying tulips. This caused the price of the tulips to crash. This story was known as tulip mania. True story. So how then will you know the real value of the stock? You use math. Specifically, you use the PE ratio, where you measure the price to the earnings of the company. On average, the S&P 500 stocks have a PE ratio of around 13 to 15. So even if the stock price fluctuates up or down, eventually the price will correct back to the normal PE ratio. No one knows when, no one knows how, but eventually it will. And if you see your stock PE ratio goes above 30, perhaps you should start selling your stock or avoiding the stock altogether. And in Tesla's case, the PE ratio is negative. What it means is that even though the company is losing money, the price of the stock is skyrocketing. There's a disconnect between the company's stock price and its profitability. The company's stock price could double, triple, or quadruple in the short term, but eventually, the stock price will return to its fundamental value. There's a quote by Benjamin Graham, the father of value investing. Let me read it to you. In the short run, the market is a wonderful voting machine. But in the long run, it is an amazing weighing machine. Well, I have no idea who I was just impersonating, but put that aside. What this quote means that in the short term, Tesla stock is just a popularity contest. It may go up or down, but in the long term, the true value of the Tesla stock will reveal itself. Rule number 3, you sell your stock when its position is too large in your portfolio. If you are investing in the stock market for financial independence like me, then you will want to diversify away your risk as much as possible. This means that when the stock has become too large, you are overly reliant on this stock. If that stock has a large percentage in your portfolio, and if something bad happens to the company, you lose a big portion of that income. So whenever you see your stock percentage becomes too big, you might want to sell away your stock and rebalance your portfolio in order to try to minimize your risk. You will always want to diversify away your risk by rebalancing your portfolio from time to time. For example, if your portfolio has around 20 stocks, you will want to give 5% to each of your stock. That way, even if one of your stock goes down or cuts its dividend, you still have all the other stocks to back you up. Rule number 4, you sell your stock whenever you have a better use for that money. Maybe you bought a stock that is losing value or is no longer profitable. Then perhaps you might consider selling your stock and move it somewhere else, which will give you a much better return. It doesn't even need to be a stock. It could be a bond, a real estate, or even your education or Bitcoin. Wait, not Bitcoin. But maybe I'm wrong. Who knows? What I'm trying to say is that if you are no longer satisfied with the return of your stock, then you will want to sell your stock and move it to somewhere else which will give you a much better return. So that's all for today. Let me know in the comments down below what you think and any topic that you want me to talk about. Like, share and subscribe as I'll be posting more videos in the future. So that's all. Bye!